Welcome to Renishaw's final results presentation for the 2025 financial year. I'm Will Lee, Chief Executive, and I'm joined by Alan Roberts, Group Finance Director. I'm going to start by talking you through the highlights of our performance this year, followed by Alan's more detailed review of our financial performance. I'll then go through the solid strategic progress that we've made this year and wrap things up with our outlook for the year ahead. FY25 has been a year of solid achievement in what remain challenging market conditions. I'm pleased to report record revenue, increased adjusted profit before tax, as well as strong cash generation. Innovation has always been the lifeblood of our business, and this year we have delivered many key new products to market. These have been developed to target specific opportunities and customer needs. A great example of this is our new Equator X gauge and Modus IM software, which will exploit the growing trend for shop floor metrology, and we are really excited about their impact on our growth in the years ahead. As we discussed at our recent Capital Markets Day, our priority remains profitable growth, but we're also ensuring that we underpin this with a more focused and leaner business. We have taken decisive action this year to reduce our annualised operating costs by around 3% of revenue, which will benefit our performance in FY26 and beyond. Whilst markets remain challenging, we expect steady growth in the year ahead. Let's look at a few of the highlights of our performance in FY25. As I mentioned, we achieved record revenue this year, combined with an increase in adjusted profit. Our organic growth strategy is working well across our portfolio of businesses against a tough economic backdrop. Constant currency growth was 3.7% this year, with good growth from precision encoders, driven by improving demand from semiconductor manufacturing equipment builders. We also saw growing demand for our agility coordinate measuring machines, while sales of additive manufacturing and spectroscopy systems were weaker. APAC was the strongest region, with constant currency growth of 7%, including good growth in China. Our operating profit margin this year is the same as last year, with the benefits of pricing, productivity initiatives and restructuring in the year, offsetting inflationary cost pressures. We are taking further action to improve our margins, and I will return to this topic shortly. Last year, we introduced a new return on invested capital KPI to signal our focus on allocating capital to profitable investments. We have turned the corner with this metric, helped by higher profits this year, as well as a reduction in invested capital as we have actively managed our CapEx and working capital growth. This discipline has also benefited our other new cash conversion KPI, which is now well above target, resulting in a strong balance sheet and cash position. Our ESG strategy is a fundamental pillar of our business, underpinning our commitment to doing business responsibly. We will be setting out our ESG goals and the good progress that we're making in our forthcoming annual report. A highlight this year has been our continued progress on reducing our statutory emissions in relation to our revenue. I'd now like to hand over to Alan, who will look at our financial performance in a little more detail.
Thank you, Will. As Will has already commented, FY 2025 was a year of profit progress and record revenue in challenging market conditions. Revenues at reported exchange rates rose by 3.1% to £713 million. We continue to benefit from being diversified across a range of end-user markets. Whilst the automotive and consumer electronics markets were weaker this year, the semiconductor and defence markets were more positive. 20% of our revenues come from the USA, whilst our manufacturing is located in the UK, Ireland and India. We have therefore been affected by US government tariff changes in our final quarter. Whilst we experienced some net costs when changes to tariff rates first came into effect, we have since been able to mitigate them with surcharges. Constant currency revenue growth was 3.7% this year. Whilst the pound has appreciated against the US dollar during the year, our forward cash flow hedging contracts have largely mitigated this headwind. Our adjusted operating profit grew at the same rate as our revenue this year, leaving operating margins stable at 15.7%. It is pleasing to note that we have turned the corner on gross margins, excluding engineering, where a combination of growth and investments in process automation has contributed to a 0.7% improvement to 61.7%. We have, however, continued to experience inflationary cost pressures with increases in engineering, distribution and administration costs offsetting most of the gross margin improvement. These costs include our continued investment in IT transformation, which we expect to streamline customer interactions and improve productivity in the future. We have taken action during the year to reduce our fixed costs, which will benefit us in future years. Our review of engineering projects resulted in the closure of the drug delivery aspect of our neurological business and the closure of a research facility in Edinburgh, which are expected to benefit operating profit by approximately £4 million per annum. And we incurred £4.4 million of restructuring costs relating to this, which are excluded from our adjusted profit metrics. We also made the difficult decision in June to initiate a redundancy programme, mostly in the UK, Ireland and EMEA, to achieve £20 million of annualised savings. Redundancy costs of around £16 million will be recognised in FY 2026 and excluded from adjusted profit and earnings measures. Our adjusted profit also excludes provisions of £4.9 million relating to interest on historical and non-recurring tax matters. The resultant statutory profit before tax is 4% lower at £118 million and was £83.8 million after tax. The underlying effective tax rate, excluding the impact of the historical and non-recurring tax matters of £9.2 million, was 21%, which is the same as in the previous year. Our progressive dividend policy aims to increase dividend per share whilst maintaining a prudent level of dividend cover. This year we paid an interim dividend of 16.8 pence per share. We propose a final dividend of 61.3 pence, bringing the full year dividend to 78.1 pence per share, 2.5% higher than last year. As Will noted earlier, we have achieved strong cash generation this year. Adjusted cash flow conversion from operating activities improved by 21% to 91%, exceeding our 70% target. This improvement was driven by a combination of lower working capital and reduced capital expenditure. Capital expenditure was £46.3 million this year, substantially lower than the prior period, as we reduced our investment in property following completion of the first phase of our expansion at our Miskin manufacturing site. As explained at our recent CMD, we are now seeking to keep our property assets stable with lower levels of additions balanced by depreciation and disposals. We are, however, continuing to invest in plant and equipment to meet the evolving needs of the business, adding capacity and increasing automation to reduce our operating costs. CapEx for FY26 is planned to be around £40 million. On capital allocation, we continue to prioritise investment in organic growth, with our progressive dividend policy providing our principal means of shareholder returns. With cash and equivalents now standing at £273.6 million, the board is increasingly focused on more active capital allocation to support the next phase of Renishaw's development. I'd now like to hand back to Will.
Thanks, Alan. We continue to make solid progress with our innovation-led growth strategy, introducing many exciting new products this year. We are now reaping the benefit of resource allocation and prioritisation decisions made in recent years, which have both focused and accelerated our development processes. This is vital as product innovation underpins our organic growth strategy, which comprises three main activities shown here. The first of these is growing our existing business in the field of metrology and position sensors, which are mainly sold to machine builders. This year saw strong growth in demand for laser encoders, which are mainly used for wafer inspection in semiconductor manufacturing. We are strengthening our leading position in this sector with a new generation of encoders that offer even higher performance combined with plug-and-play installation and easier servicing. We also continue to refresh our market-leading range of machine tool probing sensors. Our second growth strategy relates to increasing the value of our technology through the sale of systems and software. These are all emerging businesses where our key focus is on capturing market share to drive our growth. This year, we have extended our RenAM product family with a new dual laser metal AM machine. But perhaps the most significant product introductions are our new Equator X gauge and Modus IM metrology software, the outcome of substantial investment over the last few years. We expect these to be disruptive in our markets, offering unprecedented inspection speed and ease of use. They will also streamline our sales activities and open up new distribution channels. Finally, we are also extending into new, close adjacent markets. This year, we launched our new Astria inductive encoder product line. This offers robust and accurate position measurement in demanding environments, including robotics, defense, and medical devices. Astria's introduction was accelerated by deploying a minimum viable product development approach, which enables us to bring products to market faster, generating revenue earlier than had been the case previously. It also allows us to gauge market reaction, which confirms that we are meeting customer needs and has given us the confidence to invest further. At our Capital Markets Day in June, we talked about where we are targeting improvements to our operating performance. We set out where we want to drive each element of the P&L, delivered through a combination of growth, productivity, and cost reduction. Overall, we're targeting operating profit margins in excess of 20%. Now, whilst we don't expect to achieve all of this in a single period, we are taking steps now that will make an impact in the year ahead. Whilst gross margins have moved in the right direction this year, we have further to go. At our CMD, we demonstrated many examples of our investment in automation to drive productivity improvements in our recently expanded factory at Miskin. We expect these initiatives to reduce direct headcount and contribute several tens of basis points to margins each year. To reach our gross margin target, however, we will also need to exploit our recent capital investments to gain operational leverage as we grow. We have substantial expansion capacity to grow into, which will only require limited further capex and minimal additional labour, benefiting margins. We are also seeking improvements in the fixed cost elements of our P&L. Our goal is to move each of our engineering, distribution, and administration costs towards the bottom of their historic ranges by ensuring that their growth remains below our rates of sales growth. This will be achieved partly through prudent resource allocation, streamlining of our processes, and improving our IT infrastructure. But we have also taken decisive action to control costs. This includes closure of a research office in the first half of FY25, as well as the recent decision to exit our neurological drug delivery business. In June, we announced an operating cost reduction program targeting 20 million in annualized payroll savings. This has been implemented over the summer, with more than 300 employees leaving the business since June, mostly on a voluntary basis. These annualized savings amounted to around 300 basis points of margin improvement, which will help to offset inflationary pressures on the cost base during the year. The actions that we are taking to limit working capital growth, to control capex, and to reduce operational costs will also help to drive ROIC back into our target range. Now let's turn to our outlook. There has been a steady start to FY26 in line with our expectations, and at this stage we are expecting to achieve steady revenue growth in the year ahead. We remain confident in our long-term and sustainable growth model. The structural drivers that underpin our markets continue to present growth opportunities across our businesses. We are accelerating our innovation processes and making them more efficient. We're really excited by the growth potential of the key new products that we have introduced this year, as well as others that we have in our R&D pipeline. We are focused on achieving our financial targets over time. We continue to invest in our infrastructure and make productivity improvements, and we are reducing our fixed costs in relation to the size of the business with clear targets for production, engineering, distribution, and administration costs. Our resilient balance sheet provides us with the financial capacity to pursue our strategy. Following the substantial investment program at our Miskin facility, attention is now turning to the capital allocation priorities that will support the next phase of our development. Thank you for listening.
Okay, good morning, everyone. So my name is Chris Pocket. I'm Head of Communications for Renishaw. I'd like to welcome you to this live Q&A session for Renishaw's full-year financial results for the year ended June the 30th, 2025. Hopefully, you've all had an opportunity to view the video presentation that's released as part of this morning's RNS statement. Will Lee, CEO, and Alan Roberts, Group FD, are here now to answer any queries that you may have in relation to that presentation and the results statement. They'll try to answer as many questions as possible before we close at 11:15. I'll try to group similar questions together, so we may not answer all individual questions. So if you haven't already done so, you can submit questions throughout this webcast via the question icon that you can see on the control panel on the right of your screen. Okay, so let's get going. And first question here is around our industrial metrology products. So the markets appear very mixed here, with automotive weakness ongoing and machine tool data in Germany still soft, offset by the strength in your systems business. So what is your outlook for this industrial metrology business in FY 2026? And I think that's over to you, Will.
Thanks, Chris, and good morning, everyone. So with the industrial metrology market, clearly, yes, for our sensors business, selling into machine tools, probably worst case, maybe Germany, also Taiwan, those markets are really quite soft at the moment, with our customers facing challenging conditions. Here, we focus, as we always do, on the medium to long term, working on business development with those customers. And I think we're making good progress there. Particularly probably of note is on the laser tool setting side, where some of the newer innovations that we've launched with the NC4 Blue product line are really starting to help us with gaining market share there, an area where typically we've actually unusually are number two rather than number one, making really good progress. The area where we can have the more immediate impact over the shorter term is on the systems business. Here, focus very much on shop floor metrology, which we see as a high growth area and an area for us to really grow business quickly. Making good progress, and we are very positive there going forward. In terms of specific outlooks, I think early to say for the year, and we'll be monitoring and pushing that hard there.
Okay, thanks, Will. A question now on additive manufacturing. You said that AM revenue was down in FY 25, but finished the year with a good order book. So what was the book to bill for AM for FY 25? I think that's another one for you, Will.
Yeah, so AM was a bit softer. It is one of those businesses that is still relatively small, also with high ticket items. So we expect a bit more variability there. Seeing some really positive signs. Some of the end markets, they're strong. I think that defense probably is the one to pick out at the moment as being really after performance, but quicker moving, quicker decision making than something like an aerospace. So looking forward positively there for this year. Again, very early on in the year, really to comment though.
Okay, thank you. question now relating to China. Could you expand on the opportunities that you see in market segments that you do not currently serve in China? And given rising competition and resulting pricing pressures, are Renishaw margins now lower in China than in other regions? And back to you, Will.
Yeah, so if you look at it really, then China relative to the rest of APAC, there is no significant difference in margins there. So clearly we do, and we've talked about saying, are there some entry level good enough markets where we don't really operate at the moment, and there probably are for both IM and PM. Both areas are quite interesting. So commercially, we've talked about exploiting more of what appears to be an entry-level market in some of the machine shop factories over in China with lower price alternative to some of our core products, and we will develop that strategy going forward. We also see probably on the encoder market that some applications start to come in, some new applications in electronics and semiconductor come in for our encoders, and some applications start to become more commoditized and maybe drop out the bottom, but the overall market there is growing for us. So it's actually probably a complicated picture, and one I think in general we still see more positives with of opportunities, both as new things start and also with our commercial strategies. Overall for us though, China, seeing good growth and are optimistic going forward with the opportunities that we have.
Thanks, Will. Question now regarding consumer electronics markets. Could you clarify what you're seeing in this end market? It was noted as an area of strength for industrial metrology, but in his prepared remarks, Alan said that this end market was down in 2025 at group level. So what is going on here? Back to you, Will.
Yeah, our biggest challenge last year was first half of H1. Last year was tougher for consumer electronics, seeing a gradual recovery throughout the year, with H2 ending up better. Looking forward, and this is always a really tricky one to predict, but it feels like customers are now facing the necessity to make decisions that they have been off-putting. So looking forward, I think we feel more positive here in terms of investment for this over the rest of this financial year than probably we did 3-6 months ago, just because our customers have no choice. They have to make some decisions, we believe. So we are monitoring this quite closely. And the one thing we always try and do is make sure we are prepared for whatever happens here.
Okay. Now a question on pricing and tariffs. Assuming no miracles emerge from today's talks at Chequers and US tariffs remain in place, can you make surcharges permanent, or do you have other options to address this headwind, such as localizing more production? And Will, with you again.
Okay, so we have made the assumption that these will be permanent. So surcharges have been migrated and are migrating through into price increases here for our customers in the US. We've taken that route rather to look at localizing of production. We will consider our group manufacturing strategy and what we do with changes in geopolitics, but that's certainly a far more long-term decision. So at the moment, this is all being covered by now a price increase. So increased revenue to offset those additional costs that we are facing.
Thank you. Another question on end markets. Can you talk about the extent of the contraction in automotive and your expectation for FY26? Also, in relation to defence, how big is it? What is it growing at? And a rough split. And back to you again, Will.
Yeah. Okay. So to be clear, we don't know for sure the size of our exposure to these markets, because a lot of our stuff will go through integrators. So when we're selling to a machine tool builder, that they will sell on our extrapolation, and what we think is happening is roughly about 5% for defence, roughly about 13% for automotive. Defence, I think, is a really interesting area at the moment. Sadly, clearly a lot more investment going in there, and we'll talk about a little bit with additive earlier. Certainly, and I know there's a question on this coming up, I think, next on inductive encoders. It feels like there are opportunities also here with us supporting that industry directly with some of our newer encoders as well.
Okay, thank you. You've already alluded to the part of the next question. So this relates to new products, new product launches. And the question is, how are these new products performing that have been recently launched, and specifically mentioned Equator X, the dual laser RNAM machine, and the Astria inductive encoder. So back to you again, Will.
Yeah, thanks. So we've been very clear. Our strategy is very much one about using innovation, specifically new product innovation, really here to drive our long-term growth. A lot of focus has been on looking at productivity within the group, really to get some key new products through. And this is a really exciting time for us with the launches that we have made recently and are making in the next few months. Particular note, very topical, Equator X, and importantly, the new software to go through with it, Modus IM. Next week, we'll be over at the EMO trade show, a really large machine tool trade show in Germany. First significant public launch of those two products. I was actually getting a demo of Modus IM yesterday on new software for this, going through with the team. Simplicity and ease of use is really, really transformative here. This is really, really important for us in terms of looking at developing new routes to market and getting us more productive and reducing our distribution costs, our applications costs. So exciting times there with those two. Also, Astria, I think, has been a good example of our minimum viable product, or MVP strategy, with new development of getting out, testing out with customers. We've really seen a sweet spot, we believe, with defence customers here. And we've been able to take now from the initial work that we've done, so a robust, good working product, to make sure we can now do some of the final tailoring and specific for their needs to exploit that opportunity. Also with this, and the question we do get asked is then, well, what about next? What's coming through? And it's good here that we get to see, so only last week we had our encoder group review of their early stage technology. So the exciting bit here is we have an awful lot of new stuff coming through. This is right across the board for the group. Now our focus is on the productivity. How do we help our really talented engineering teams get these products through to market sooner, making both priority call decisions, and also how do we support them to make sure they can operate as productively as possible.
Okay, thanks, Will. We've got some similar questions here on relating to costs, and specifically the 20 million labour savings. So if I just try and whiz through these and try and join some of these together. So what is your expectation for underlying cost inflation in FY26? Can you talk us through the main moving parts of the FY26 operating profit bridge, including how much of the 20 million savings will be seen in FY26, What is engineering cost inflation, labour admin inflation, savings from facility closure, and any ERP costs? And also, are there any other savings within the 20 million that might take time to filter through? So that's trying to amalgamate a few questions there. So start with Will, and I think it's going to start with Alan on that one.
Thank you, Chris, and good morning, everybody. Yes, there's good progress on the cost reduction program, which alongside the closure of our drug delivery business and the closure of our facilities, R&D facilities in Edinburgh, which are going well. And we expect these to have a cost saving of around about 24 million. However, we do have the pay rise that was put into effect at the beginning of this year, and possibly a likely similar percentage coming up in January 26, and also based upon a turnover, a payroll cost of around 300 million. In addition, we do have the £3 million of incremental national insurance over and above the previous year that we have to accommodate. On the other side, in addition to these cost reduction measures, we are further looking at productivity initiatives across the business in all areas, including the rollout of our global ERP program. So looking at our logistics automation, investments in manufacturing equipment that we've been putting in over the last couple of years, and the processes that we're focusing on, which you would have probably seen if you were at our CMD a few months ago, when you went through our manufacturing plant. A lot of initiatives are taking place in cost reductions. And we're starting to see some of those coming through now, which will in fact impact our gross margin. And with the rollout of our e-commerce platform as well. So there are a lot of initiatives going on across the board with regard to cost management.
Okay, thanks, Alan. Tariffs again. Trump implemented increased Section 232 tariffs on certain steel and aluminum, I guess we should say, products in August and post your year end. Does that affect any of Renishaw's products? And if so, what is the impact? Offset mechanisms, including timing. Will, I think that's for you.
Yes, I think we've probably answered most of this already. So yes, we do get caught up in the tariffs here. We have now switched over to price increases rather than a surcharge. It's about a 1% impact on revenue, about £9 million. So we feel in a comfortable place there. Clearly, it's lots of discussions with customers in getting to that position. So I don't think too much more to add on that one.
Okay, thank you. Question about cash. There's nearly 300 million of cash on the balance sheet. Any plans to deploy this via M&A, or in the absence of that, would the management consider a special divvy or a buyback? And what would be the preference between these two options? And there's a similar question noting that, or asking, could we give more colour on the, quote, more active capital allocation that you referred to in today's statement? So, Will, start with you on that one.
Yeah, so let's just, I guess, underpin this with the things that we are trying to achieve at the moment. So in terms of the priorities and initiatives for us here, Alan has talked about a minute ago on the productivity side. of saying, yes, our number one strategy is still very much the revenue growth, profitable revenue growth through innovation, but we will underpin that with being more focused and more productive. Now, with that, on top of that, we want to make sure we're pushing up our cash generation from that profit, and also being prudent with our capital investment over the next few years. This is generating cash for us, and correct, we are up to now almost 300 million. As I mentioned at Capital Markets Day, we are discussing this. It is a hot topic of discussion for the board as to the use of that cash and what we do. I don't have any new information for everyone at the moment on that, but what I can say is it is something that is being actively discussed with the board at the moment.
Okay, thanks, Will. Question now on the search for the new CFO, and the question is, how is it going?
Yeah, so very early stages, nothing really to add on that at the moment.
Okay. Question on expense. So I think this is going Alan's way. Can you remind us of the phasing of IT infrastructure spend and whether this is going above or below the line? Alan?
Thank you, Chris. Yes, the phasing of the ERP rollout is actually very active right now, because we went live in the UK, Ruxel, our UK sales activity, which is probably one of the most complex implementations that we will have during the whole rollout program, and that went live 10 days ago. So, and we're working through it, and we are shipping product. So that's good news. Then we're going to be rolling it out through Germany, and then through America, and then progressively through APAC and the rest of EMEA. So that's going well, and we're looking to do a lot more of the in-house rollout ourselves. So whilst there will be further costs incurred with consultants in this current year, and it is all above the line, actually. So, we have been burdened with that over the last couple of years, and so it will reduce over time, over the next 2 or 3 years, as the rollout progresses.
Okay, thanks, Alan. Just looking through, I think we've already answered. There's a question on tariffs. I think we've pretty much answered that. We've talked through capital allocation. Question, Alan, I think for you, what do you expect the effect of currency to be during FY26?
Thank you, Chris. Our forward currency hedging program seek to mitigate the short-term volatility in our results due to currency, and at this stage we don't see a significant net impact in 26 versus 25. We do have average forward US dollar contract rates, forward rates for 26 and 27 at 127 to the pound and 128 for the following year. This is against the current rate, 136. So we're in quite a good position in that respect.
Okay, thanks, Alan. I think we've answered everything that's come in. Unless there's a late flurry, I'm not seeing anything. So I think that's it. I think we've now ended. I think it looks like there might be a question coming in. We'll take this one. It's just coming through the system. Just wait for that one. Okay, just snuck this in before the end. So how does working capital move as a percentage of sales given potential growth? And how does CapEx look beyond the 40 million this year? And Alan, put that one over to you.
Yeah, we're looking at around about 40 million for the current year in terms of CapEx. And for the following couple of years also, that sort of order. The major spend, which was at Miskin, as you would have seen at CMD, was the build and construction of halls 3 and 4. The major element of that expansion program took place in the last couple of years. So we're well prepared going forward in terms of capacity, production capacity, and the availability of hall 4, which could come through depending on our growth over the next few years. So 40 million a year. In terms of working capital, I wouldn't expect to see any significant movement in working capital statistics over the next 2 or 3 years. We do exercise very tight control on our debtors and working capital and inventory. There's quite good control on our inventory management process, which will be further enhanced and improved as the rollout of our ERP program proceeds.
Okay, thanks, Alan. Another question's come in on currency. So can you remind us of the FX impact that came through in Q1 of 25, and if there could be a similar impact this year?
No, we don't expect. There was a one-off benefit that we got from autumn 22 when the Liz Truss mini budget. We took the opportunity to get some good contracts, which came through in the first quarter of last year. I think it was circa around about £5 million, and we don't expect that to reoccur this year.
Okay, thank you, Alan. There's a question here about order trends. Could you touch upon order trends? The development was noted to be encouraging in Q3. What has the development been like in Q4 and the last few months? I think that's one for Will.
Yeah, overall positive, slightly up. I think those broad themes we talk about of actually APAC overall being positive at the moment, Europe's still really struggling, and the Americas being a bit more complicated, but with some encouraging signs, but also some risks there remain true. I think we would also say that we view the sort of semiconductor electronics as being in an unusual sort of steady growth rather than its normal cyclical ramp up and down. And I think, as we talked on earlier, we sort of see consumer electronics as being probably going into a more positive phase, but really not sure. So I think those are the bits I would probably pull out. Clearly, we've touched on some of these other bits earlier as well.
Okay, thanks, Will. I think that really is it this time. So that now ends today's session. As ever, we'll aim to publish a combined recording of this webcast and results presentation on the IR section of our website by tomorrow morning. And just to point out that whilst we've had no questions today on the new reporting segmentation, we will be publishing results for the new reporting segments at 0700 BST on Tuesday, 23rd of September. So if you can look out for that. So on behalf of Renishaw, just like to thank you all for attending this event and have a great day.